Hi guys, and welcome back to Economic Street. I'm Ola.
And I'm Nicholas.
And today we're going to be carrying on the conversation on investing. And we're looking at one particular aspect today known as mutual funds. Now, last time, Nicholas, we spoke about getting onto the stock market.
Correct, yeah.
Whereby people can look to buy shares in companies.
Yeah.
However, mutual funds actually makes it easier to get access onto the stock market, doesn't it?
Yeah, so what essentially a mutual fund is, it's a pool of assets. So, for example, me, you, and other investors could put our money together to then invest that money into a pool of securities. Well, when I mean a pool of securities, so shares, bonds, government bonds, so money market products. So what that is essentially diversifying your portfolio, because what you're essentially doing, you're investing a lump sum of money but into different asset classes.
Okay.
So instead of having all your money in shares, your money is split across and spread. So that's known as diversifying your portfolio.
Okay. Let's break that down. So we've got, first of all, you said it's people coming together to put money into this pooled asset.
Correct.
But we actually don't have to know each other because it's all kind
That's
of
correct.
right now. So it's literally
It's changed,
Yeah.
because then, as we spoke about in our previous about getting onto the stock market, if you get in touch with a broker, brokers actually have
mutual funds
listed on
their platform.
Correct. So as I said, the days of actually you physically going around to all your friends, you can actually
do it online now.
Correct, through your broker.
And they literally, so some of these funds are billions. They're worth
Correct.
billions.
There's different sizes.
Yeah, but essentially, think about it this way: it's like having a cake, and everybody gets a slice of that cake. The assets in this cake are the ingredients that you've used, so the milk, the butter, the sugar, whatever else goes into that. Those represent the assets. So those represent the shares in Vodafone or Tesco's,
Correct.
Apple. They can also represent bonds, government bonds.
Correct.
So bonds are whereby a government has gone to borrow money from people, essentially, and that bond, they pay you an interest. So bonds also represent an asset, and it can also include these assets. These ingredients can include other things like property.
Correct.
So and other sort of
They're more exotic type of mutual funds.
Okay.
But your standard mutual fund will be typically made up of shares, government bonds, and corporate bonds. They're what you call your standard mutual funds. So say the advantages of having a mutual fund is that they give people with
low money.
So if you haven't got a lot of capital, so not a lot of money, it gives you a chance of getting started to make income for yourself in the future.
Yeah.
Because a mutual fund is pulled from all other people, and as I said, now you get it online where there's mutual funds already set up. You're just putting in a small amount
and getting like a very small slice. So it might be a small slice. So rather than owning one share in Apple, which can cost hundreds.
Correct.
Because you put your money to
Correct.
Apple. But at the end of the day, it's giving you access to being able to invest. And I like what you said. It's all about diversifying your portfolio.
Yeah.
Can you just explain what the benefits of a diversified portfolio is?
Assets all of one class. Or not even just one class, but in terms of the same type. So because you got So when I mean by diversifying, so you've got shares, bonds, and then even with bonds, you have government and corporate bonds. You have a mixture. So, for example, if your shares fall, but the government bond won't be rising, they then balance out
each other.
That's what you want. You want to have a portfolio where they have a negative correlation. And what I mean by negative correlation is when one goes one way, the other one goes the opposite way.
It kind of
nets off.
So it's basically a way of reducing your risk.
Correct.
Especially if you're risk averse.
Yes, because as I said, if you got everything just in shares, or just just the one share,
let it ride.
Yeah, and then that share collapses.
Yeah.
You're then stuck because your risk is all on that one share.
Okay, so that's a great benefit of it.
Is there also a risk? Is there also lower return then?
Correct. So that's a very good question. So we
just received a question off camera. One of our listeners.
In a mutual fund, it works both ways. So in the sense of with your return, because I said you're only owning that small portion, your return is then also based on that small portion as well.
But at least it's still a way for people to get started.
Correct.
Okay. Next thing, let's talk about how mutual funds actually work. So usually it's managed by what is known as a fund manager.
Yes, correct.
Who has a team around him. So these are the guys that will go out and determine what assets or which company shares to buy, which bonds to buy, and the proportion of these. It's also important to know that each fund also has a different strategy. There's something that they're trying to achieve. So whether that, usually it's either they're trying to make income for you to receive as dividends,
correct,
monthly, or they're trying to achieve capital gains. So, or they can have a mixed strategy of these two.
Yep.
So that's how they then determine which company shares, assets to buy for this fund. It's just up to you to do your research and select the fund that you want to invest into based on its strategy and also probably based on its previous performance.
And also its fees.
Because
they charge a fee for managing this
money on
your behalf. So each mutual fund manager will charge different fees depending on past performance, etc. So you need to weigh up, that's another cost that you need to weigh up in your decision.
Okay. So let's actually concentrate then on the fees, charges. So some funds, there's actually an initial investment fee for actually just putting your money into it. There's also a switching fee. A switching fee is whereby you want to move from one fund into another. Usually these fees are around 0 to 2%. They're increasingly getting lower because the industry is really competitive. So it's like the insurance market, like car insurance. There's so many options available, and therefore people are always constantly switching, and so premiums, you can get lower premiums.
Yeah.
So it's the same with this investment world. Depending on the funds that you go into, depends on the kind of fees you pay. There's also another one known as the annual management service charge, which is what you just pretty much touched on, which is where they get a slice of
it's kind of like a performance fee as well.
A performance fee, exactly. Almost like a commission for
how well they managed the fund.
But they do receive this fee whether it performs. So that's one thing you have to be aware about. I know we've touched about the risks a little bit, but essentially the risk with investing in mutual funds is essentially kind of the same as investing in the shares of a company.
Correct.
In terms of your capital is at risk.
Yep.
So the industry always says one thing: past performance
doesn't guarantee future
returns. And it's important to know that because I think as well as having the potential to go up in value,
it's also got the potential
to go down. So that's the main thing that you have to understand when you're essentially becoming an investor. If someone wants to start now, how do they basically go about the selection process?
So it's coming down to from what our topic was before about getting onto the stock market. The first point of view protocol would be to look for a broker.
Okay.
And the thing is, as I mentioned earlier, because the capital base is so much smaller for mutual funds, you've got a great head start because you don't have to have so much capital.
I know you can start with as little as £10.
Yes. Yeah. So what you need to do, like on our topic about getting on the stock market, research your broker because there's many different brokers out there. And once you've also reached that broker, research the mutual fund in question as well. As I said, there's different variables you need to take into account when choosing the fund you wish to then invest in.
I know, for example, for me personally, I use a broker called Hargreaves Lansdown just because they have such a massive range. Yeah. It's like going to Tesco's and just having so many options.
Yeah.
But also, what they do is they prepare a list of like top performing funds or the ones to look out for. They, all these kind of things. So it's almost like a great starting point. But a lot of them brokers do this whereby they might have the top picks.
Correct.
Or they have a selection that, okay, these are the ones that are doing well in this particular sector. Because what people need to also remember is that these funds, apart from having specific strategies, also focus on different markets. So some will only invest in the UK, and within the UK market, they might only invest in companies.
So like the car industry, for example, they very, because they do get specialised funds.
as well.
So and it depends. So you might actually, and that might be a starting point for yourself because you've got a interest in a particular area. You choose a fund based on that. So yeah, there are many different types of funds out there that you can choose from.
And I know there's some that offer ethical investing, so they won't touch tobacco companies,
Correct.
for instance, or alcohol companies.
Yep, that's correct.
So yeah, there's a lot of range available. The next thing I wanted to move on to is the fact that these mutual funds, you can hold them within what is called an ISA.
Correct.
So an ISA stands for individual savings account.
Yeah.
And every year, everybody over the age of 18 gets an ISA allowance from the government. That runs from tax year to tax year. So 6th of April 1 year
to the 5th of April
next year.
Sure.
Currently, that allowance is £20,000
for the stocks and shares ISA.
For the stocks and shares ISA. Well, you can split that
again between
across all the different types of ISAs. So there's stocks and shares ISAs.
Yep.
There's cash ISAs. There's also something relatively new called innovative finance, which allows you to invest in sort of like startups and all that kind of stuff, Kickstarter, sort of ventures. And there's also the help to buy ISA, for example. But explain some of the benefits of ISAs.
So where the benefits of the ISA is that it's tax free.
Okay.
So meaning in terms of you within that pot of money that you've got, you don't get taxed on it.
So if you make interest on the income,
correct,
it doesn't get taxed.
Correct, as long as it's within gains, as long as it's within that pool, so that £20,000 pool, you don't then have to pay the government tax on that.
Okay. I guess the logic behind that is because that investment you're making, the money you've used to make that investment has already been taxed because it's coming after tax has been deducted from your salary.
That's correct.
So yeah.
And also in terms of a lot of when you go through brokers, in terms of they work out taxes for you as well. Okay. So in terms of capital gains and stuff like that, that can already be worked out for you by the broker.
Okay, fantastic. So for me, that's always a great starting point. Always use your ISA allowance because this is basically an ability to invest tax-free.
Yeah, that's correct.
Don't waste it. So, you don't have to have a king's sort of inheritance or king's...
I say you can have a low starting point.
Yeah.
You can start. Obviously, then it will take time, but at least it's a starting point.
Yeah. The only thing about the ISA allowance is that you use it or lose it.
Correct. So
it doesn't roll
each year it
over.
doesn't roll over. So each year, if you've not used your allocated investment or allowance, then the next year you just get a new allowance. It doesn't roll over.
Fine anyway. So just starting off, you can invest on a monthly plan. So you can just set up a direct debit. Little as £10, some of these funds will accept, or you can just invest a lump sum, £200, £500, £1,000, whatever you have. But it's just important to just start, and then you can start to see what kind of returns you're making. Especially because, like we keep mentioning in our episodes, inflation is going up.
Yes.
So if your money is just sitting in the bank account,
you're technically in real terms you're losing money
because your money, the value of your money is going down, meaning you can't buy as much stuff
with that same amount of money.
So cool. So that's mutual funds. That's just a quick insight into mutual funds. Is there anything else that you want to add to that?
No, that's just a quick roundup that we wanted to give viewers. We had a few questions when we done our introduction of getting onto the stock market, and that's another example, another financial product out there if you want to begin and start investing. Yeah,
we'll drop the links on the online platform to a list of approved brokers that the London Stock Exchange provides. Yeah. And if you have any other questions, just get in touch, let us know, and we'll be happy to address them.
Yeah, keep in touch, guys.
Thank you. Any final questions from the people watching in here?
Does a mutual fund mean any type of asset class?
What do you mean?
So, can I invest in anything as long as I do it with other people? It counts as a mutual fund, or does it have to be within stocks, bonds, and?
So mutual funds is a port saying in terms of if you go out to a broker's website as well, they're starting to branch out, but the classical mutual fund is a pool of bonds, shares, so corporate bonds, government bonds, and shares. That's your classical mutual fund.
infrastructure funds, so real estate funds,
Correct.
which is like commercial property. But there's a lot of them now increasingly also providing alternative investments. So there will be funds that invest in hedge funds, or there will be funds of funds. So these are mutual funds that literally are designed to invest in other mutual funds. And by putting that together, again, it diversifies the portfolio and can make different returns. But ultimately, to come back to your question, mutual funds, that's what a mutual fund is. It has to be pooled investment for it to be a mutual fund. But there's different types of mutual funds also.
So that means returns on mutual funds usually are really low.
Not necessarily. Because at the end of the day, it's linked to the stock market, or it's linked to the assets that they invested in. So if someone invested in hedge funds are known to do exceedingly well or fail miserably. So you could be making 40% return on a mutual fund that invests in hedge funds versus a mutual fund that just tracks the stock market, like the FTSE, that only makes maybe 5%. So it ultimately depends.
Varies on how much you put in and then the products that are being invested in.
Some also invest in commodities like gold, silver, all that kind of stuff. So again, it just depends on what you're looking to achieve and what you want your portfolio to hold. Awesome, thanks for that question. Please do send in your questions or your comments and anything else you want to add. And we'll be sure to cover them in future episodes as well. So thanks for tuning in. That's it from me.
Have a good evening.
Yeah.